Are you just starting out in trading and wondering if your trading strategy or system needs to be refined or improved or replaced? Well, if you are, then there's a very simple formula that will help you answer that question once and for all. Hello and welcome. My name is Dean Miller from WealthTip, where our tip for wealth is to trade, invest, and prosper. And if you're new to this channel, then simply go ahead and click the subscribe button as well as the notification bell, and that way we can stay connected and continue adding value as we journey alongside you on your way to success. Now, many people starting out in trading goes on a quest in search of what many professional traders would call the Holy Grail of trading. And if you don't know what the Holy Grail is, then it's simply just a strategy that has a 100% win rate. Now, many so-called trading educators and trading mentors exploits this idea for their own benefit, where they'll offer to sell you a course that has a strategy that has a 90% win rate, or you can consistently make $100 or $1,000 a day. And to be honest, when I see these types of things, I encourage people to remember a very simple but very famous saying that applies to these types of institutions. If it's too good to be true, it probably is. Now, granted, there are a large amount of opportunities within the markets, but in order for you to take advantage of these opportunities, it requires a lot more than just a trading strategy that you may have gotten on the internet or in a course that you may have done. It requires that you understand the statistical edge of a particular strategy within the markets itself and the probabilistic outcome of each trade being taken using that particular strategy. The common theme that ties this entire series together is that it's not enough to just have a winning strategy or a winning system. You need to have a profitable one. And the way that you can determine if your trading strategy or system is profitable is by knowing the following. What's your strategy's win and loss rate? What's the average win and average loss? What's your strategy's profit factor and statistical expectancy? And to round it all off, what is your expectation ratio, which is the last formula that we're going to be covering in today's video. And by simply using these formulas, you can easily determine whether you need to refine or improve or simply just replace your current trading strategy or system. And the earlier you're able to determine this, the closer you'll be to having a successful career as a trader. Also note that these formulas also helps you determine if you have a profitable trading strategy or system and by how much. So it's really a must-have for anyone that's looking to have a successful trading career as a trader. So like we already mentioned, this is the last and final installment of the series, and the expectation ratio will tie everything that we've learned so far all together. The expectation ratio reflects how effective your trading strategy or system is by measuring how sensitive it is to changes in the average loss. So the greater the expectation ratio is to the average loss, the higher the expectation. And with a high expectation, small changes in average loss will have little impact on your net profits. However, as the ratio gets smaller, the small changes in average loss will get greater and will have a greater impact on your net profit. Now, this particular formula has 3 rules that comes with it. Rule number 1, if the expectation ratio is less than 0, then the expectancy must be less than 0 and it's a losing plan and it should not be traded. Rule number 2, if the expectation ratio is between 0 and 0.5, then the plan is okay, but you should monitor your losses to make sure that the average losses does not increase, ultimately increasing the probability of it negatively affecting your net profits. And rule number 3, if the expectation ratio is greater than 0.5, then you have a robust and profitable trading strategy. So the formula is as follows. It's the expectation ratio equals statistical expectancy divided by average loss. So for the last time, let's have a look at Tom and see what is his expectation ratio. So last week we calculated that his statistical expectancy is to be $83.33 with an average loss of just $45.05. And if we were to put these figures into the formula, then we would end up with an expectation ratio of 1.8. This means that Tom has a very robust and effective trading strategy. And as long as he's able to maintain his average losses at $45.05, he'll continue to grow his account. Essentially, what Tom has taught us in this series is that it's not about how much trades you win, but much rather how profitable you are. And like we said, Tom's strategy only has a win rate of 20%. Yet according to each formula, he remains profitable, and more importantly, he remains sustainable. And this will ultimately lead him to have a prosperous career as a trader. So if you would like to replicate Tom's trading approach, all you have to do is follow and use these formulas for yourself, and ultimately by then determine what your next move will be. From my side, however, I want to say a big thank you for joining me on the series, and I really do hope that you've enjoyed it as much as I enjoyed it putting together. Furthermore, I wish that you have an awesome day further and have a profitable week ahead. Up until next time, keep well and bye for now.